This course is Derivatives Securities. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. In this video, we will cover Chapter 5 of the excellent text on Options, Futures, and Derivatives by John Hall. The title of this chapter is The Determination of Forward and Futures Prices. We make a distinction between consumption versus investment assets. Investment assets are assets held by large numbers of people purely because they believe the price will go up and they will make money over time. To a large extent, this is gold and stocks, and mostly silver, although silver is consumed to some extent, and manufacturing processes, particular things like lenses that change color in the sunlight, and in old photo stock to make x-rays and pictures. Consumption assets are assets held primarily for consumption. Examples would be copper and oil. Again, these are not perfect distinctions because some people buy copper for speculative purposes and some people also buy oil if they believe the price will go up. But largely, gold and stocks and silver are held for purposes of investment, and copper and oil are held for the purposes of consumption. We'll also define short selling. Short selling involves selling securities you do not own. So you, through your broker, borrow securities from another client and sell them, and then you hope that the price of the security will drop and you will be able to buy it back at a later date. So your objective as always is to buy low and sell high. It's just in the case of short selling, you actually do the selling before you do the buying. If you short sell, for example, a stock that pays dividends, then during the time period you have borrowed and sold it, the individual you have borrowed it from, of course, still expects to get their dividends and you must pay them. There is also sometimes a fee for borrowing the securities, and at times in the past, organizations like E-Trade have charged a rather high fee for this. Bigger companies that are engaging in hedge fund type activities will have significantly lower fees than you might as an individual investor. As an example, consider the following situation. You short 100 shares when the price of the stock is $100 and close out the short position 3 months later when the price of the stock is $90. During the 3-month time period, a dividend of $3 per share is paid on the stock. What is your profit? Well, the profit's going to be the 100 shares times the $100 you sell it for, which is a positive, minus the $90 you have to pay for it, minus the $3 in dividends you have to pay out. So this is going to be $7 per share times 100 shares, or a $700 profit. The other side, what would be your loss if you had bought the 100 shares? Then you would have paid $100 per share, and you would have received a positive $90 when you sold it, plus $3 in dividends, for a loss of $7 per share times 100 shares, or a loss of $700. These two are, of course, the same, since the long and the short have to cancel out. When looking at futures and forward contracts, we will use the following notation. S0 will be the spot price today, whether that's the price of gold or a stock. F0 will be the futures or forward price today, so the price that the forward on gold is trading for, and that could be expiring in a year, 6 months, whatever. The delivery date is the expiration time T, and little r is the risk-free rate that's appropriate from now until the maturity at time t. Let's consider an arbitrage example. Suppose that the spot price of a non-dividend paying stock is $40. The 3-month forward price on the stock for delivery is $43, and the 3-month US dollar interest rate is 5% per year. We ask, is there an arbitrage opportunity? Once again, we will see that there is an arbitrage opportunity. The theoretical no arbitrage price for the 3-month forward would be the spot price e to the RT, just like the future value equals present value e to the RT for an investment. This is going to be the spot price of the non-dividend paying stock of $40, e to the 1-year interest rate of 5%, times 3 divided by 12, since it's a 3-month forward, are once again, as before, $40.50. The 3-month forward price, on the other hand, is only $39. So the forward, in this case, is underpriced compared to what it should be. You will therefore buy the forward or go long the forward and short the stock. When you short the stock, you will get money from selling the stock, and you will get that money and invest it for 3 months at the risk-free rate and make a profit of the difference between this and this, are $1.50 per forward. It's not always possible to engage in short sales. Well, the formula would still work as an investment asset because investors who hold the asset will still sell it and buy forward contracts when the forward price is too low, but this process may take a little bit of time because not all assets are securitized. For example, say that the price of cattle and the price of the forwards on cattle are not consistent with the formula, and the spot price of the cattle is too high. Well, cattle are not securitized, and if you go to a farmer and say, I would like to borrow your cows and sell them, and I will bring them back later, the farmer probably will not respond very well. So this is a process where making the formula work will take a little bit longer than if all of the assets involved are securitized and traded frequently on organized exchanges. We just looked at the example of a non-dividend paying stock. Well, you could have a dividend paying stock, and then the formula is going to be slightly altered when an investment asset provides a known income. Now, rather than just being F equals S naught e to the RT, F naught will be S naught minus I, where I is the present value of the income during the life of the forward contract, or the present value of any dividends that will be paid before the expiration of the forward contract, and then S naught minus I altogether is taken to the E to the RT. This can also be expressed in continuous compounding. When an investment asset provides a known yield, then now F naught is going to be S naught, not just E to the RT, but E to the, in parentheses, R minus QT, where Q is the average yield during the life of the contract for a continuous payment. And of course, we can convert from one formula to the other just by changing the way we calculate yields. Valuing a forward contract. Well, a forward contract is initially going to be worth 0 when it's signed by both parties, except for the possibility of a bid-ask spread. Later, it may have a positive or negative value depending on how prices have changed. So suppose that K is the delivery price and F naught is the forward price for a contract that would be negotiated today. Well, sometime in the future, of course, these things can change. So by considering the difference between a contract with delivery price K, that's what's written in the contract, and a contract with delivery price F naught, we can deduce that the value of the long forward contract is this. So we signed the contract for K. Let's say a cattle we believed would be priced at K in a year, but now the market believes they will be something above K. So if you are long this contract, you still get to buy at K, and the price has gone up to something above that. So on the day of delivery, you will make a profit per unit of the contract of F naught minus K. What is the present value of that today? F naught minus K e to the minus RT. And of course, the sum of the long and the short position has to equal 0. So the value of the short forward is going to be K minus F naught e to the minus RT, since they are agreeing to deliver for K, and if they had waited until today, they would instead be delivering for F naught. Forward versus future prices. While the maturity and the asset price are the same, the forward and future prices are usually assumed to be equal. There are things that could make this not true. For one, forwards are commonly more risky than futures, so you might not just be discounting at the risk-free rate for a forward. There is a higher probability of default, and futures are market-to-market daily on the exchanges, so there's a very small probability of default. That's one reason there could be a difference. Another reason is correlations with interest rates. So when interest rates are uncertain, they're going to be slightly different. A strong positive correlation between interest rates and the asset price implies the future price is slightly higher than the forward price, because in this case with a future, since it's market-to-market daily, you will get paid daily, and then you can deposit that money in a interest-bearing account. So if the price keeps going up and it's correlated with interest rates, the price of the future goes up, interest rates go up, you get a higher price and a more benefit from being the long and being paid than you would for the short. And of course, a strong negative correlation with interest rates would imply the reverse. One example of that would be the euro-dollar futures contract, which is a contract that is settled based on an interest rate. How about a stock index future? Well, it can be viewed as an investment asset paying a dividend yield. For example, the S&P 500, I think now, pays about 1.5% dividend yield. So the future price and the spot price relationship is therefore F naught equals S naught e to the risk-free rate minus the dividend yield, for example, on the S&P 500, times T, the time of expiration of the forward, and Q is the average dividend yield on the portfolio, represented by the index of the contract. For this formula to be true, it's important that the index represent an investment asset. In other words, changes in the index must correspond to changes in the value of a tradable portfolio. This isn't completely true for the Nikkei index, for example, when viewed as a dollar number. It doesn't represent an investment asset. The reason for this is the Nikkei index itself is quoted in Japanese yen, whereas the future contract is quoted in dollars, in particular 5 times the value of the Nikkei index. So a direct arbitrage is not possible. You would have to do something more complex involving yen versus dollar futures as well. An investor can engage in index arbitrage whenever F naught does not equal S naught e to the R minus QT. For example, if F naught is greater than S naught e to the R minus QT, an arbitrager buys the stocks underlying the index and sells the future. So you will sell or short whatever is greater and buy whatever is less. And in this case, since it's an arbitrage, you're not going to have to invest any of your own money, so you would borrow the money to buy the stocks with. And of course, for this arbitrage to be true, right now, for example, R is going to be less than Q if we're looking, for example, at the S&P 500, because the rate of return in dividends, Q on the S&P 500 is around 1.5%, whereas the risk-free rate is close to 0. If we have the opposite situation, if F naught is less than S naught e to the R minus QT, well, you always buy what is underpriced, so you would go long the futures and short the stocks, And when you sell the stocks and short them, you get cash, and you would invest that at the risk-free rate R. But of course, during the time period before the expiration of futures, since you've shorted the stocks, you would have to pay out the dividend yield represented by Q. Index arbitrage is quite complicated. It involves simultaneous trades in futures and many different stocks. For example, 500 stocks of the S&P 500. Most likely this would be done by a computer, and you would have to have a pretty large difference for this to actually work, considering the bid-ask spreads of trading the 500 different stocks. So it would be common for when simultaneous trades are not possible and the no arbitrage relationship would not work, at least for very small variations in the formula. What about futures and forward contracts on currencies? Well, a foreign currency is analogous to a security providing a yield. The yield would be the foreign risk-free rate. So it follows that if RF is the foreign risk-free rate, for there to be a no arbitrage condition, the forward on the exchange rate, for example, British pounds versus dollars, has to equal the spot on the exchange rate of British pounds versus dollars, e to the R US dollar risk-free rate minus R pound risk-free rate times T, where T is the time period until the expiration of the future R forward contract. If you take a class in international finance, you will use this formula in great detail. So a little bit more of an explanation of why the no arbitrage situation exists between spots and forwards. Let's look at, say, 1,000 units of a foreign currency, yen, euros, pounds. Well, if you invest that money in the risk-free rate in, for example, Great Britain, then at the end of time period T, you would have 1,000 e to the RFT. And if you have signed a forward contract that expires at that time T, well then, at that time T, you can take that money and trade it at that forward contract F naught. Alternatively, at the same time period you here invested the money in the foreign currency's risk-free rate, you could have converted that money at the spot rate S naught into dollars and then invested that in the risk-free rate in dollars. So since this is a risk-free transaction, this is a risk-free future amount, and the only possible risk on this side would be possible default on the future and forward contract. If this is a future on a organized exchange, they have never defaulted, so both of these, both the left and the right, are basically risk-free transactions for the future value, and if they are both risk-free, they both have to be equal. If we cancel the 1,000 on each side, we are left with F naught equals S naught e to the R minus RFT, are the formula we showed here on the last page. So since both of these are risk-free investments, that formula has to be true. For consumption assets, for example, cattle, copper, corn, items of this sort, we will also have to have a storage cost, which can be looked at as a negative income. So an equality would be F naught, the future on the consumption asset, equals S naught e to the R plus UT, where U is the storage cost per unit of time as a percentage of the asset value. Alternatively, this can be written as S naught plus U e to the RT, where now U is the present value of storage cost, just like earlier I was the present value of dividends. Another complication with consumption assets is we will find that you can't necessarily put an equal sign here for the no arbitrage condition. We will go into some detail for why this is the case. First, we will look at the situation where the future forward price is greater than the spot price e to the R plus UT. Well, under these circumstances, the arbitrage would be to short the future, which we can do, to buy the underlying commodity, which we can do, and to purchase it by borrowing at the risk-free rate R, and then also paying the storage costs U. So under these circumstances, an arbitrage is possible. So if F is greater than S e to the R plus ut, we can do an arbitrage. So this condition cannot occur. F cannot be greater than S e to the R plus ut, because an arbitrage would be possible then, which will prevent this from lasting for a long time period. But let's look at the other situation. What if the future price is less than the spot price e to the R plus ut? The arbitrage now would be to go long the future, to short the commodity, and to take that money and invest it at the risk-free rate R while saving the storage costs U. Well, for a consumption asset, you can't always short the commodity. For example, copper, you can't necessarily borrow that from somebody and sell it, because the copper market may be dominated by people who own the copper and want to use it for construction, for example, copper wire in building houses. Same for something like cattle. You can't necessarily borrow a cow from the farmer and sell it, because the farmer is going to want to use that cow to process and sell and make a profit in beef. Therefore, it is possible for consumption assets for this to be the case, for F to be less than or equal to S e to the R plus ut, and an arbitrage may not be possible. We will now look at two more definitions, the cost of carry and the convenience yield. The cost of carry, C, is defined as U plus R minus Q, where U again is the storage costs, R is the interest costs, and Q is the income earned. For an investment asset, we have shown that F naught has to equal S naught e to the CT. Our arbitrage is possible, whereas for a consumption asset, F naught has to be less than or equal to S naught e to the CT. Our arbitrage is possible. We will define the convenience yield on consumption assets as Y, and it will be set so that F naught will equal S naught e to the C minus YT. For investment assets, of course, Y is 0. For consumption assets, Y is greater than 0. We will now ask the question, are futures prices the same thing as expected future spot prices, or what is the relationship between them? And the answer is, it depends on the kind of asset. Suppose that K is the expected return required by investors in an asset. K is just like the K out of the capital asset pricing model. Well, we can invest F naught e to the minus RT at the risk-free rate and enter into a long futures contract to create a cash inflow of S of T at maturity. So this today will equal S of T at maturity. Well, if people expect a rate of return K from investing in an asset, say the stock market, between now and maturity, then that has to equal the same thing as the expected spot price at maturity times e to the minus KT. We can rearrange this equation in multiple different ways. One of them is shown down here. F naught equals the expected spot price at maturity, e to the R minus KT. So whether or not the future price is a good predictor of the expected future spot price depends on whether K is greater than or less than R. If K equals R, and there's no systematic risk, i.e. beta is 0, like a bank account style investment, then F naught equals the expected S of T. On the other hand, if K is greater than R, which would be the case with a positive beta or a stock market type asset, you have positive systematic risk, and F naught is less than E to the ST, or the future price is less than the expected future spot price. If you have K less than R, this is an insurance type product with a negative beta or a negative systematic risk, and then the future is going to be greater than the expected spot price. This is the case in some situations for gold and would be the case in a lot of investments that you would expect to be negatively correlated with your overall portfolio are insurance type investments. I thank you for watching this video.